But let's go back to the banking and the BFSI updates that have been coming in. We do have Nitin Aggarwal, Senior Group VP Head of BFSI at Motilal Oswal Financial Services. Nitin, great to have you in. So I'll come to the big lenders later. We were just discussing this, the same thing with Dharmesh before you joined in. Let's start with the non-nifty names that have reported, and a whole host of PSU banks in that list, including PNB. There are a lot of the small finance banks that have reported. So what stands out for you? I mean, I noticed that most of the SFBs, no one's lighting up the charts with growth. It's largely, single-digit growth. So just tell us your trends, reading through the weekend updates.
Yeah, hi. Thanks for having me. And I think this time the business update has come out to be fairly strong. If you'll see, not much expectations were there from 2Q, while we did see some pickup in the business activity in the last 10 days out of September, especially after the GST cut. Otherwise, the commentary and even the RBI numbers that were running, for most of the quarter, were fairly kind of soft. And in context to that, most of the PSBs have reported a fairly strong growth. Across the board, we have seen growth ranging between 3 to 6% on advances on a sequential basis. And for SFBs also, the growth is for our coverage, SFBs is between 4 to 5%. So both AU and Equitas have reported a fairly healthy sequential pickup. And this is when MFI sector, we are still expecting trends to remain soft. There could be again a decline on a sequential basis in that segment. And only a Union Bank, as I see amongst the PSBs in our coverage, has reported a softer trend, and which is probably as the bank remains mindful of the pricing and is not growing aggressively in the corporate book at all. Otherwise, RAM growth, I guess, across the board for all PSBs will remain fairly healthy, something that we will see.
So in this universe, when we are talking tier 2 financials, tier 2 banks, would you have any picks before we talk about what HDFC has done and the other big boys have done?
Yeah. So certainly, we wrote our PSU Bank thematic note just 8-10 days back, and we continue to remain positive on the space. And within the pack, we like PNB, and SBI, of course, within the larger names remains a preferred buy. But besides that, we like PNB and Indian Bank within the PSU banks. And amongst SFBs, AU continues to remain our preferred idea. The stock has done very well over the last few months or few quarters, you can say. Only in the last after the last results, we did see some decline because of the MFI stress and some uptick in the credit cost. But we remain confident that by the time you end the year, I think the earnings will be on an upswing. And that, in context to how the bank will shape up as a transition to universal bank happens, will continue to drive a very strong earnings as well as a balance sheet CAGR.
Got it. Hi, Nitin. Good morning. Good to see you. What about RBL Bank? There's some news that the street has been sniffing for a bit, unsure whether or not that will come through with regard to any kind of fund infusion. But for the time being, that operational update that they put up is pretty good. 14% growth is what they've delivered on the loan book. It's crossed 1 lakh crore or thereabouts. The stock has run up considerably from the recent lows. What's your view on the counter?
Yeah, certainly. So RBL has, the stock has done really well. We upgraded the stock around 8-9 months back. And while we continue to maintain a positive view, and we believe that as the MFI stress continues to recede and provisioning therefore comes down, you will see ROAs inching up towards 1 by Q4 is what the bank is guiding. And in our numbers, we are estimating somewhere around 1.2 in the following year. So as you see that earnings momentum is catching up and the growth run rate, what they delivered in this quarter is also pretty strong. It's a 6% sequential growth that the bank has reported. And it's the only bank in our coverage wherein we are expecting NIM expansion in 2Q. So as this also strengthens further, that will give more confidence in the earnings and their ROA delivery. And that will help the stock continue to do well in the coming quarters, we believe.
Okay, all right. Nitin, if I remember correct, I think you're also tracking the credit card business, right? SBI cards. The stock, obviously, over the last few years hasn't given much returns. But what's the view right now? There is an entire talk that, credit card spends will go up and the likes. Do you believe that the stock could perform from here on?
I think while the overall retail spends continues to track well, though it's not comparable to what it was, say, 5 years back. But last year, we did see some overall moderation in spends that was mainly because of the corporate spending, which came down very sharply. And retail growth continues to be somewhere in the mid-teens, we believe. And that number we feel fairly confident about. But the problems around asset quality is something that has impacted the stock performance. The running credit cost continues to remain elevated. And though second half should be better than the first half is what we are penciling in. But given that the overall number per se in terms of credit costs sustaining above 9% currently is something to be watched for. And margins, another key parameter, it has been trending up, but it's a very calibrated uptick that we have seen in margins, despite a very sharp decline in repo rate cuts. Now, if we go on to see some more repo rate cuts, which is a good possibility, then I think this will continue to aid the earnings recovery for the stock. As of now, we have been maintaining a neutral rating on SBI Card.
Okay, got that. Nitin, now let's talk about the private sector big boys. And here it's getting, it's a very interesting pitch, right? There's HDFC Bank, which is back to delivering almost double-digit growth, almost 10%, 9.9%. Though Dharmesh was just telling us that he, for instance, is still a little concerned about margins. So give us your view there. There's Kotak, no growth problems, 15% year on year. And there is IndusInd, where, of course, numbers are weak and it's not a patch compared to its peers. But there is clarity on leadership now, and a very well-respected leader has taken over the bank. So could this be the time to be looking at IndusInd beyond the near-term subdued performance?
Right. So 3 stocks you talked about.
Yeah.
HDFC, I guess, pretty strong business update. Advances growth certainly has come in better than anybody's expectations. And after a long time, we are seeing such a sharp rise in CD ratio. Otherwise, the focus for the bank has been to bring down CD ratio. But I guess Q4 will normalize it, because Q4 is a time when seasonally they typically report a very strong deposit growth. So on a full year basis, they will still be lower on CD ratio versus where they were at Q1. And but this advances growth certainly instills the confidence the bank is well positioned to deliver growth in line with the system. That's what their guidance is, that they will look to grow somewhere closer to the system, which we believe will be around 11. And so with this pickup in the advances, they are tracking well on that. And on margins, I think the decline will be very limited. We are penciling around 10-11 basis point decline for margins, and Q2 should be the bottom on margins front. Next quarter, because of the CRR cut and because of the gradual deposit repricing, I think margins will start to recover from the next quarter onwards.
And would you buy IndusInd now, going against the near-term concern? And obviously their growth is no comparison to the others for obvious reasons.
Yeah. I think IndusInd is a stock wherein this quarter one shouldn't really look too much on the numbers, on the business update, because it's a management clarity and the execution, therefore, in the coming quarters, which matters more. And this quarter, while, yes, both the advances and deposits have been a slight decline, but the strategy going forward and the recovery in the core business, both in vehicles and microfinance, because these are the 2 segments which have induced a lot of stress, that will be critical, alongside the pickup in the rest of the business lines. And which is where we believe at the current valuations, downside definitely is limited. And as you get more clarity around execution and the management focus on the segments, and the outcome of therefore the profitability estimates will matter more. And we currently have a neutral rating on IndusInd, but certainly there is not much of downside that we see on the name as of now.
Okay. All right. Got it. Interesting take. Thank you very much. Lots of numbers there. Thank you for making sense of all of them.